Welcome to the show this week. We got a great show lined up for you. We're going to be posing some questions to you. Are you paying too much in taxes in your retirement? I bet you're shaking your head. Learn more about that. Do you know what the 4 C's of banking are and how that may affect you at various aspects of your life? What are 7 mistakes people make when picking an advisor and how you want to avoid that if you can? And finally, what is the financial cycle and what does that mean to somebody planning for their retirement?
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
I want to talk about, are you paying too much for taxes in your retirement? And I'm sure you just said yes, no, even though if you don't know what you're paying, right? That's everybody's response. But really, if you're coming up on retirement soon or already early in retirement, what is your retirement tax plan? You hear about us talk about that all the times here. But do you know what you're going to pay? That's something we do here all the time for our clients. Have it mapped out over the years. We call them mock tax returns. It allows us to take year by year, assuming the current rates, and map out what each year looks like. Think about it this way too. At some point, if you're not already there, you're going to turn the age of 72. At that time, if you have IRAs, 401ks of such, you're going to have to take required minimum distributions. At that point in your life, what is your projected tax rate going to be? What are you going to be paying? What does that look like? So having a plan to see if you're going to be paying too much specifically at that time can be vital. We call that a tax bomb. All of a sudden, a year hits and you have a way bigger income, and then it caused maybe a significant tax increase for you. Wouldn't you like to know that in advance? So with that said, could we potentially lower taxes in the future by paying more today? I know it sounds a little bit confusing or even a little bit contrary to maybe what people believe as we defer it down the road. But what if by deferring, we were only causing more cumulative taxes over time? Often people get trapped in looking at individual years versus the long-term equation in a retirement. Think of it. Most of us are going to be retired for maybe 20 or 30 years or longer, even in some cases, if you're fortunate to retire early. That's a lot of cumulative tax. If we can maybe do some proactive tax planning to help you out, wouldn't that be nice? Finally, surviving spouse. If you are married and are in the married filing jointly tax brackets, things for single taxpayers are dramatically different. Really consider what you can do as a married couple with taxes to help potentially benefit that surviving spouse down the road. So if you don't have a tax plan or you are not sure what you're paying, let's change that. Give us a call at the number on the screen. We'd love to sit down with you and review this for you. And boy, if there's even a little bit of way to better your tax situation, wouldn't you like to know?
Well, what another great segment there on taxes. That old saying of there's only 2 certainties in life, right? Death and taxes. But if we can save you just a little bit on taxes, I think we earn our keep there. Kind of reminds me of a story where I had a client that his whole working life, his goal was to retire and purchase a new diesel truck. So when he got to that point last year, we figured out the price, and it's closer to $60,000 that he would spend on that diesel truck. So we went over that. We went over what are the tax consequences of doing that. Based on his income when he retired, he was in the middle of the 12% tax bracket or so, and he had about $20,000 worth of wiggle room that he could remain in that 12% tax bracket. However, if he took that $60,000 lump sum and paid for that vehicle, he would bump up into that 22% tax bracket. So we went over all of that with him and showed him if he spread those payments out and didn't take that full $60K at one time, we could save him about 10 cents on the dollar for $40,000. So it was a huge eye-opener for him, but also a great opportunity to save a little bit of money too.
Yeah, I really appreciate that story, Nick, because that's one of the fun things that we get to do here. We have a tool that will take all of the different puzzle pieces financially that you have, and it puts it in one place. And it actually predicts how much you might have to pay in taxes over potentially your lifetime. And I say that it predicts because really who knows what's going to happen with the tax laws. Right now the rules are established, and so what we do is we look at any kind of immediate play that we might be able to put into your plan based on the current laws. After we plan and execute the plan, then typically what happens, tax laws change, and we just start the process over. So if you have questions about where you're situated from a tax planning perspective, please give us a call. You know, our goal is to make you as tax efficient as possible with all the money that you've saved for your entire life. So stay tuned. Coming up next, we have the 4 C's of banking and the 7 mistakes that you have when picking a financial advisor.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best is Yet to Come, presented by Centennial Wealth Advisory. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The big 3 being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided, and a spouse or guest may attend for free. The class will be held on Wednesday, November 10th and November 17th from 6 to 9 p.m. at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700.
Hi, my name is Jack Klunder, and I am a financial advisor with Centennial Wealth Advisory. I work out of our Cadillac office, and we specialize in retirement planning. We take a very holistic approach. We start with investments and see how you're situated there. We do wealth management. We do income planning. We do tax planning, any kind of healthcare issues or needs that you might have for insurance. And then we talk about what your legacy plan might be. So if you are nearing or in retirement and you have questions that you want to go over, please give the number on the screen a call, and we can have and set up a free, no obligation consultation.
All right, we're going to talk about the 4 C's of banking, essentially talking about borrowing money. So let's start off with the first C, which is character. You think about back in the day with the banks and everything, you probably knew the loan officer, maybe knew the president of the bank, and you were able to walk into that bank and everybody knew you and knew maybe you were of high character, and that ultimately they'd be more than happy to lend you money just based simply on that. I know my grandfather, who passed away before I was born, Emmett Shea, was over in the Alpena area, and he was the president of a bank back in the 50s and 60s. So I picture what life would have been like for him as far as lending money. The second C comes to collateral. You know, what is it that you can put up for collateral? Is that a vehicle? Is it a piece of equipment? Again, going back in time, thinking about, you know, the farmer that just needs a little additional funds maybe to put out his crop for the season. Maybe he's going to put that expensive equipment, the tractor, up as a piece of collateral. The third C, cash flow. how vital it is that you have the ability to pay back that loan. And it's not just a matter of, okay, what do you have coming in, but maybe how long have you been seeing that income? I mean, a lot of times people want to see, bankers want to see, okay, the past couple years worth of tax returns, but it's definitely helpful when you have a long-standing position with the company and regular income showing that, okay, this is not just a short period of time that you've been collecting that income and can cover those expenses. The fourth C, credit. Agencies are out there and they're regularly rating you on your credit score. What has been your past payment history? Maybe how many loans do you have and how long have you had those open? That's something that I struggle with. I'm not a big fan of loans. I like to not have debt and make sure that bills are paid as quickly as possible. So it amazes me that the more loans that you have potentially can improve that credit score that you may be looking at. So again, those 4 C's of banking or borrowing: character, collateral, cash flow, and credit. All vital things that you should be paying attention to, and ultimately be prepared to go to that bank and take care of that loan.
Professional golfers have a game plan. Knowing where to attack the golf course is vital, and avoiding the hazards is key. As you can see, we aren't professional golfers. But at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. Give Centennial Wealth Advisory a call or visit us at cen-wealth.com and let us help you plan to retire well.
The stock market has a natural life cycle that is destined to encounter peaks and valleys. Those scenarios are frequently preceded by events such as changes in interest rates, new international trade negotiations, treaties, and tariffs, fluctuating levels in the national debt, global events that threaten the economic stability, political controversies that impact national policies, dramatic news headlines that shape investor sentiment. While each of these issues, and certainly all of them combined, generate cause for concern, it's important to remember that we have been in similar circumstances before. One way to help gauge market-related anxiety is to consider observations made by renowned investment experts who have weathered many markets' ups and downs over the years. Contact us today for a complimentary portfolio risk assessment. We'd love the opportunity to help you plan to retire well.
Seven mistakes you make when choosing an advisor. Number one, not picking an advisor that's a fiduciary. Now, a fiduciary is just somebody that has to act in your best interests, okay? Obviously, everybody wants that kind of an advisor, you would think, but not all advisors are fiduciaries, so that's number one mistake. Second mistake you make is just hiring the first advisor you see. If you're looking for an advisor, you're looking for somebody that you connect with, that you're going to trust, then I would dare say I would visit more than just one. I would maybe see one, two, or at least say 2 or 3 at least, just to get a feel for, the differences with advisors, to pick one that might be a better fit for you. Number 3, choosing one with the wrong specialty. Now, if you go to an advisor that just sells insurance products, what do you think is going to be the answer to all your problems? Insurance, right? If you pick an advisor that's just selling stocks, bonds, mutual funds, what do they think is going to be the answer to all your problems? You guessed it, right? So you're going to want to understand, if it's somebody that's more independent, that can sell a vast array of financial instruments, might be a better fit for you. Number 4, picking an advisor with an incompatible strategy. If you're picking an advisor who works really well with somebody that's in the growth and accumulation phase of their life, they're working and take on a lot more risk, and yet you're somebody getting soon to be retired or retired, that advisor might be incompatible for you because they're looking at more growth strategies when what you really need is more preservation and wealth. So picking an advisor that's got an incompatible strategy. Number 5, not asking for credentials. That's very important. You see those commercials on certified financial planners and how the guy ended up being a DJ or disc jockey, and they were going to put all their money with this person. What kind of credentials they have, but even most importantly, what kind of experience. Has that person been in the business for quite some time? More likely, if they've been in for 20 years, they've experienced the last 2 market drops, and maybe they're going to be, that experience is going to, help them in making forming a better strategy for you, and also knowing what's out there and what's available. Number 6, not understanding how they get paid. People want to know how people get paid, and it's very important. Are you paying too much? But transparency is a real key to that. Number 7, not getting references. Now, a lot of advisors, they can't give you testimonials. That they're not allowed to do that. They can't post them on websites. But they can get permission from some of their clients to allow their name to be given out for referrals. So sometimes if you just want to see how a person's operating with others, ask for those referrals. And I'll give you a bonus mistake, not calling me. I encourage you, if you're somebody that needs an advisor or just wants a second opinion, call Centennial Wealth.
Well, I hope that you found those couple segments very helpful. When they were talking about the 4 C's of banking, I couldn't help to think about how much has been changing lately in the banking industry. I have clients come in all of the time saying, hey, I have to change my bank information because my bank is changing. So when you talk about some of those loans that you might get based off of your character, your relationship with your bank, hey, those are kind of changing. And so then when you get down to how do you raise money to do different things in your life, well, they're relying a lot on your credit score. I know you've heard probably people say you can do life without a credit score, and I think that's awesome. And I think that's super ideal to be able to get to that situation. But what is your reality? Where are you at? Well, that's something that you want to understand, because if your reality is not to the ideal, well then let us help you be taught how to put a plan in place to get to that ideal. Right now we're in that school season and my kids are coming home with their report cards and they're getting that feedback on where they're at school, and report cards are going to last as long as their schooling does. But what happens when they get out of school? What is their report card? Well, when you get to be an adult and you're in our world, your financial statement is your report card. And so I think it's really, really, really powerful to have financial education. And that's one of the great things that we get to do every single week, is try to teach you about all the different things financial so that you can go on a learning journey and you can get your financial statements into that ideal place that you'd love to get them to. And so if you have any questions or you're concerned about something, give us a call. You'll never be pressured, and we always have education first.
Absolutely right, Jack. That's our job, is to go through this retirement with you and to teach you, okay? So we want to sit down with you every 6 months at least to go over those statements, to make sure that you understand the various instruments and tools that you have at your disposal to make sure that your goals in retirement are accomplished. I know the guys talked there about the 7 mistakes of trying to find a financial advisor. Recently, I just had a couple that came in and they had on their statement a guy listed as their financial advisor that they had never even met or talked to. That is something that, if you're working with us, you're going to hear from us, okay? So make sure that if you're not hearing from your current advisor, you find somebody that you're going to hear from. So stay tuned. We're going to talk about the financial cycle next. You don't want to miss it.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best is Yet to Come, presented by Centennial Wealth Advisory. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The big three being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided, and a spouse or guest may attend for free. The class will be held on Wednesday, November 10th and November 17th from 6 to 9 p.m. at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700.
Are you nearing retirement or in retirement? Have you had your portfolio just looked at or have a second opinion on that portfolio recently? Centennial Wealth is a full service advisory firm, and we have multiple locations in northern Michigan. I'm in the Gaylord office primarily. The office is right downtown Gaylord. Also up in the Petoskey office as well. That office is right off of 31. I'd love to hear your story. I'd love to sit down and chat, and it's a free, no obligation consultation, so just call the number on the screen.
Many of you might not know this, but I had my own tax and accounting practice for over 25 years. I had to advise a lot of businesses over those years, and I would always refer to what I called the financial cycle. But I wanted to kind of give you an idea what that looks like today, because I think it's just as relevant when you're looking at the market as a whole. So I just want to show you kind of this relationship and when it's healthy and when it's not healthy. Okay, again, they call this the financial cycle. You know, you got what's called a profit and loss statement. That is basically your sales, the total revenue you're bringing in, minus your cost of goods sold. If you're a retailer, that's the cost of your inventory that you're selling, minus your operating expenses. You know, that's your rent, utilities, wages, all those kind of things. Well, after you take your sales minus your cost of goods sold and your expenses, you get what's called your profit. And you're hopefully hoping that's going to be more than that, right? Now, there's also a financial statement called the balance sheet, okay? That just basically shows you a snapshot of your organization as of a specific point. So it's basically your assets, everything you own, equipment, inventory, buildings, and the like. It has to equal all your debt, your liabilities, and your owner's equity, okay? That's the relationship. Your assets equals your liability plus owner's equity. Now, here's how the cycle works. Your assets help you generate your sales. So if your assets are inventory, whether it be equipment or what the like, they're going to generate your sales. Then it's going to go down through what's called this, what I call the noodle maker, right, to generate a profit. Now your profits can only go one of three places. They can go back up into new assets, okay? They can either go pay debt, okay, your liabilities, or they can go in owner's equities pockets to maybe then turn around and pay dividends, okay? So if this is a healthy thing, you're generating enough profits to be able to do all these three things and generate enough assets in your sales, you have a healthy cycle, okay? But any one of these things become unhealthy, you have an unhealthy cycle. So let's say that I have enough to pay my debt, and maybe I'm paying into the owners, but I don't have enough to fuel my assets, then that's going to slow down my sales, which is going to affect my bottom line. So folks, when we look at the economy and we hear things like low interest rates, okay, that's good for corporations because their ability to pay debt is good. But as soon as interest rates rise, their ability to pay all that to debt gets less and their financial cycle can be hurt. All right? Let's say growth is slowing and sales are starting to decline. That's going to lower their profits and then make this unhealthy. So just like a human being where we have organs and they all have to be in balance, the financial cycle has to be in balance. So when you're hearing things in the economy about slower growth or higher interest rates or any of those kind of things, know that there's a lot of good reason behind it. So hopefully you found this valuable, just something I thought you might want to know about. If we can be of help in any way, then please give us a call.
Hey, I hope you really enjoyed what Larry just taught you there. I thought that's really important to understand. I thought he did a really good job making it very simple. And he talked a lot about what we actually look at when we're looking at the different investment options. It's not just the name on the investment, it's the underlying fundamentals of those businesses, of those companies, of what's going on in the economy below just the headlines. And so the business cycle there that he taught you about is really helpful to just kind of understand what their options are. We get all the way down and everything happens and we have our profit. What do we do with our profit? Are we going to go buy assets? Are we going to go buy liabilities or decrease the liabilities? Are we going to put more in our owners' pockets? Are we going to pay some dividends? What are the options from where you have your profit? I also couldn't help but think about it applying to a personal level. Really at the end of the day, you go to your work, you get your job, trade your time for money. At the end of the day, you have this income and you get to choose, what am I going to do with my income? Well, are we going to go buy some assets? I don't know. We're going to go pay down some debt of personal liabilities. Are we going to just save up for a rainy day fund and put it in our savings account? I have people all of the time that are asking those questions. Hey, in this low interest rate environment, should I just should I invest instead of paying off my house? And really the answer to all of those kind of scenarios is very individualized. And that's what's fun about what we get to do. We get to individualize a plan and say, here are the pros and cons of doing that. Here's the pros and cons of doing this. And it's always fun to get to meet you, and so you'll never have pressure. You can always just learn about your situation and maybe what a best path forward is.
Absolutely, Jack. When that personal financial cycle comes to mind, in my mind, it's the transition that a lot of clients have from from their working life going into retirement. They don't know what that looks like, that new financial cycle that they have. One thing comes to mind just real quick here is that I had a couple that came in and with their financial cycle, they were going from their working years to retirement. And they weren't quite sure on how that transition looked. And so we mapped out their expenses and so forth. And in their expense plan, they totally forgot about that they were contributing almost 19% of their take-home pay to their 401k. So after we kind of reduced that contribution to their 401k, dropped their expenses down, the picture became very clear that retirement would be feasible for them. They didn't have to worry about that extra expenditure anymore. So very, very great show there talking about the financial cycle. But don't forget, stay tuned next week. We're going to be on the same time, same networks, and we'd love you to come back and watch us again.